Game. Loading.
Welcome to Mobile Gaming CFO Insights from Pollen VC, the only podcast that gives you the inside track on challenges and opportunities for CFOs and accidental CFOs, sharing tips for founders on the best practices for funding and scaling their mobile gaming companies. Hosted by mobile analyst, tech consultant, and frequent contributor to Pocket Gamer and Forbes, Peggy Anne Salz.
Thank you, Ricky, and thank you for tuning in. It's great to be hosting the debut episode of a new series where I will be interviewing mobile gaming company CFOs, people who have been charged with the responsibility for finance at their companies, and the occasional accidental CFO who has grown into the function. And you'll hear from both in this series, and both will provide us hot tips, smart tricks, and even a few shortcuts from the people who know, because that is their daily job. So we kick off today with Adam Banks, who heads up the finance function at Viker. Viker is an indie mobile game development studio in the UK, specializing in developing casino, action, and puzzle games, and probably best known for titles including Scratch Day, Boxtuber, etc. Viker develops games for Android and iOS users and generates revenue through advertisements and in-app purchases. So it's great to have you, Adam, on the show. And we'll start with a question on everyone's minds, right? Everything has changed with COVID, a windfall of organics, perhaps, a huge audience, mostly. Many you didn't plan to acquire in the first place, but here you have them. So tell me, what are you seeing at Viker right now?
An influx of organics is actually remained fairly stable in terms of the organics because we're only a relatively new studio, so we don't have the scale of someone like a Playrix or anyone like that. So we only really started ramping up within the last year, and this is kind of something we're still doing. So we can't just run away with it and go stupid on user acquisition present. We're slowly building that up. So I think if we'd been a bit more established, we could absolutely have probably pushed on a bit harder. But I think for cash flow reasons, you've got to be quite sensible in that respect.
Okay, that makes sense. And it's also interesting because you would have to have a much tighter interplay between finance and UA and marketing. What is the structure there, or how do the two of you work together? Or are you in the process of maybe thinking differently around how you need to work together?
We have a daily catch-up once a day with the UA team, and we also have a commercial meeting twice a week just to kind of focus what the strategy is going to be, how we're going to be implementing the UA spend, what's giving the best returns at the moment, where we think it is responding when we're ramping up. So a lot of data analysis on the ROI, the early stage ROIs on install day one, see how things are returning. Obviously, retention is quite an important thing there as well. But getting the UA team who come from larger company backgrounds to understand that just because you potentially have a good CPI and it looks good versus things we've done in the past, if a game might not be returning at a certain point in a certain country, just because the CPI looks good doesn't mean we should be going for it. It's all about that kind of return on that investment. That's the critical thing for the business from my perspective at present.
What do you think it is that you bring to the table in the way of value and able to fuel this growth? Because as you said yourself, this is the type of thing where it's a company where you can acquire a lot of users, you should, and you are, but on the other hand, to quote you can't go crazy with UA either. So what is it? Is it discipline that you bring, direction?
Accountability, I would say, is the critical word. Right from day one, I was told we have to make people accountable for anything that they're doing. If things aren't working, it's quite useful alongside the product team as well. The product team is very metric savvy, very driven by metrics, and anything that doesn't look right, we say, well, why are you doing this? What's the reason for it? It's not delivering. Let's investigate it. We've got KPI targets in mind all the time. And if things aren't reaching those levels that we're expecting, then it's what's going wrong. How can we fix it straight away? So making people accountable for the way they're spending in UA and across the business as well. So making people accountable for any form spend in the overhead space. It's all got to be going in the right direction for the business. So I'd say it's accountability is the critical thing that I've been brought in for. In other aspects of the business, in company sales. Most people that are setting up an app business want to exit at some point. I've gone through exits before, so I'm bringing that knowledge as well. Probably less relevant for this interview, but that was kind of a critical thing for my hire as well.
How would you describe the board reporting?
At the moment, as I say, it's a startup, so it's very, very light. We've only just started building up on that. So at the moment, it's kind of just your P&Ls, your balance sheets. At present, we're adding a little bit more around the performance of some games, so we can kind of highlight which games are and aren't ticking the boxes at the moment, because we are a studio of games, not a single game studio. And things on cross promotion of games, that's quite an important thing that investors are wanting to understand and see some data on. CPI trends, so that obviously they can compare it against what they're seeing in other businesses that they've invested in. I think, and then the payback periods, that's another one they're interested in, to understand how that's going to affect the cash flows. They're kind of been the key ones that have been coming out.
Mm-hmm. I'd like to just have you talk at a high level around the funding options that you see, since cash flow is so critical to watch.
So I think there's a couple. So one funding option is, obviously we have got in an external investment through angel investors, people that are in the industry, respected names, because we thought if we surrounded ourselves by a team of people who have been there and done that in the industry, they can bring some really valuable knowledge, experience, and also some contacts as well for either further investments or link ups, looking at deals outside of just the standard gaming, looking at things with IP, where we're bringing on a known quantity that can bring in a lot of organic traffic for us. So that's one way of investment. The other way, in terms of the UA funding side of things, is we used a company called Pollen VC, and we are able to leverage our debts and of the kind of the Facebooks and the Iron Sources and the Unities of this world, not just the current book debts, but also kind of the ongoing debt that's accruing throughout the month. We're able to borrow against that at a certain rate of interest that helps fund that as well, because it's essentially a cheaper, you're giving away less equity and you're kind of giving it away into loan finance. So short term, obviously you pay a little bit more out, but longer term, it's a better balancing model for the company.
What do you need to understand UA? I mean, is it finance leads, the understanding of UA, or is it marketing? You were talking about that before, but it's also a balance between the two.
It's totally a balance between the two teams, because from a finance and analytics perspective, you can look and say, still, this isn't working. And you can come up with suggestions. And yes, you are learning all the time, but you go, well, could we try this or try that? Or these particular geos are working. Can we put more into them? The UA expertise comes in, that knowing, for instance, that if you just target a specific geo, then the CPIs are going to increase in that one geo. But obviously, coming in fresh, you don't realize that you can't just always target a geo. Sometimes it makes sense to target that geo because the returns are sufficient, even if the CPIs go up. But other times it will push them up so much just by targeting a single geo, because the ad networks are pretty wise to what you're doing, and they obviously want to make as much money as possible. So they don't always help the UA teams in that respect for the app publishers.
So part of what you do is keep people focused on the numbers, keep them thinking about accountability. That's a way of working together with UA. That way they're free to do what they're doing best, which is exploring options and opportunities and new geos and new demographics and all those new opportunities. But it has to come back to the bottom line. Are there any metrics that you are encouraging or even training the UA team to embrace more aggressively than, say, what was before? Because LTV is extremely important. CAC, we know these, but there are so many different models. Are there metrics or models that you're rallying them around?
I push mainly ROI, but obviously they're kind of keen on, ROAS seems to be the standard one. They're not far off of the same thing. As long as either ROAS is above 100 or ROI is above 0, you're starting to get yourself into a good place. I came from a background where LTV to CAC was the absolute critical on a 3-to-1 basis through SaaS metrics. Due to the kind of numbers of users involved here, you don't need to be hitting a 3-to-1 ratio if you're keeping your overhead sufficiently low. So we kind of target something around like the 25% on, or 125% ROAS would be kind of what we're aiming at. We're basically pushing for a positive return because we know organics will also bring that beyond and make us profitable. But the ideal on UA spend is to get that break even, knowing that organics will pin us above that. So that is the primary focus for our UA team, is to push in that respect. But also, I think sometimes they look at things in isolation. You'll have people who are experts on, say, the SDK networks, or you'll have people are more on a Facebook. And I think where they're putting a particular app in a particular geo, they will often look very siloed and forget about the organic side of things. And sometimes the organics in certain geos can do better will obviously do better than the organics in others. So we encourage them to take a kind of step back and look at the bigger picture, not get so ingrained in the details sometimes. Sometimes you can lose sight of what's been successful. And so I tend to sit in that higher space just to give them some direction, because they won't always notice it themselves. It's just giving that little bit of a nudge every now and again.
There has to be this structure. It can't be that you're the person with the spreadsheets that they come to and who says thumbs up, thumbs down. It has to be a bit more part of that. And it is in many, many cases.
It's going to be very, very kind of a commercial role, this one. It's not your typical finance. The amount of invoices and whatever else that's flying around is minimal relative in an app business. The fact you've probably got a couple of invoices from Facebook, one in, one out each month. But then you're looking at the level of transactions within that is astronomical. And that's really where your key data is. That one invoice, one in, one out takes minutes. The rest of it is where you've got to be really focusing your time in the finance function.
So you're looking at a lot of the data that you're almost, I don't know, sort of an invisible member in a way of the UA team. You're there, but you're not there. You're sort of integrated and watching. You're enabling them. You're liberating them to unlocking their abilities to do their job the best way they can. But you're also contending with a lot of data. Do you have any advice you would give founders around maybe how to prioritize this, or how to handle it, or how to approach it? I've spoken with CFOs who have like a daily routine. So I'm just wondering what you could offer as some advice here.
We have a tool that kind of aggregates everything. So I wouldn't look at a source individualism. I think you can get a little bit too narrow-minded and stop looking at organics and the overall performance of an app in a geo. Basically, my data is pulling all the cohort data I can and going in and understanding what's going on in different areas, what's working, what's not working. Cohort is the kind of critical one, but I'm kind of tracking back. So I'm looking at, say, install day. How's install day performing against past install days? How's that being impacted? Is retention changed? Is there any issues with any of the games? Like, so we've got some good product guys on board as well, who are tracking the games within the kind of minute by minute, second by second. But sometimes things will get missed. So I'm there kind of mopping up in the morning in case anything has been missed, and you kind of go, well, this isn't, something's gone wrong here. Let's get this sorted. And I think just having that can save you quite a chunk of money. If you've got something wrong and you're acquiring people and the retention's dropping off because, say, for instance, a new user comes into the app and it's not quite functioning properly, or the onboarding slightly off, you'll notice that drop in retention, and that's basically just killed that cohort. So it's also bearing in mind that some cohorts could have died in the past when you are tracking back and looking, or sort of always looking historically. So I'm kind of going install day, what's it doing on install day? And we've got rough targets for that. And you try and model the two out. You try and get from install day and the kind of RPO on install day, where that's going to model out into an LTV. Is it going to be successful? It's all that kind of thing. So cohorts is basically where I spend all my time. You've got a little bit of reporting around, because you kind of got the financial reporting side of things around the non-cohort view, because unfortunately you can't recognize future income against your UA spend in your financial statements because it's not certain. The reality is, from a management reporting perspective and understanding what's going on in the business, that's driving absolutely everything. You want to know what your spend now is going to equate to in future income.
You talked about how you look at things and that you have a tool, and we're trying to also get an overview of some of the tools to get an idea of, what is the toolkit.
The accounting software is just a very basic software at the moment, zero. We don't have a need for anything above that. We could grow substantially, and that would actually still servers, as I said before, you've got one invoice coming in and going out for Facebook. Most of it's kind of coming through bespoke built stuff that's relying on data from the likes of, say, Admost, Adjust, AppsFlyer, places like that we're kind of aggregating. We're checking, a couple of sources against one another to make sure that our sources are coming through accurately. So that kind of double checking by having data from two sources. That feeds then into an enormous database. And my database is, I have kind of almost a mini database query that's run off that will refresh at certain times. I'm only really concerned about whole day. I can go in and look at in-day ones as well, if so inclined. But I'll have whole day data when all that's come in, and I'll be able to go back and have a good overview of things that are going on just in full day data. Certain things don't come through till, say, 10 a.m. in the morning. After that, it will all refresh, and I'll be able to start working on it at that point. Then we're using something called QuickSight. We've got, you can build in targets in there. So that's through Amazon. It's Amazon QuickSight. That rips all the data from our databases and puts it into nice graphical formats. Because I encourage the UA team. I think a lot of the time people will download things from some of the things like an Admost or, an Adjust or an AppsFlyer. They'll download reports and they'll just look at tabular data. I think tabular data is great for the detail. But if you want to see trends and patterns and understand what's really going on, if you put something to a graphical format, you get a lot better picture. I use the graphical formats to tell a story. When we have the commercial meetings, I'll say, this is this and this has worked, this hasn't worked. As you can see in these graphs, these are the impacts these things have had. Whereas if you're just looking at a block of data, that doesn't help. I'll be sending things to the two founders of the business, just saying, I found this particularly interesting. This is an area for concern that I think needs looking at. And you kind of take that from any business. If you put data into a proper graphical format that is basically being used to tell a story, it's a lot more powerful than just some numbers on a piece of paper that people ultimately aren't going to look at.
Absolutely. It's more actionable.
Yes.
It's more understandable. You see more context. Is this what investors want to see, or is this also what you have to make relevant and understandable and accessible for UA and even for product for that matter? Who wants to see what, and how do you sort of balance that? Because in a way, I wouldn't say you're not the gatekeeper, but you are preparing this in a way that it is digestible for each constituency, if you would see it that way.
Product come into our commercial meetings just to have an understanding of what's going on top level, and we'll drill down. You never kind of going really off the same reports. You have the same starting reports, which are the kind of the top level ones, but any variation in those, you're using kind of subsets of those reports that you're drilling down into to tell the story of what's going on in the business and things that are clearly needing attention. Obviously, products are monitoring games on an ongoing basis, so they're tracking other things, are RVs being served, what percentage of people are seeing an RV, what percentage of people are playing more than one game, just general things like that, number of impressions served. So they're checking things that are looking healthy in terms of a real-time basis. Where they're trying to keep track of so much data, they can sometimes miss things. And I think that's where that check the next day comes in, really, from me. I will flag things up again through the graphical data, because that's what they're working with all the time. That's what they understand is the graphical data. They'll pick up on that and they'll go, oh yeah, we do need to sort something out. Something isn't quite right. And then that'll get sorted pretty quickly. And you see that correction the next day. And that having me sat there, I feel like I'm adding value, because I'm picking up the things that no one was picking up before. They might take days or weeks before someone went, oh, that's not, we've not clocked that. Bringing in a senior finance person for the first time, you pick these things up, you pick the errors up a lot quicker, because they're just not going to get through, because you look at the overall numbers and go, these are just, something isn't quite right. You have a feeling for it. It's like a sixth sense you build up after years in finance.
Is there something you can share about the milestone or the accomplishment, as you said, your instinct, or just the different way of framing the data? What could you share?
I think there's probably a few things already. One, I clocked retention in one of the games was off. The platform's only come relatively recently, so these things weren't overly being checked on. And I just thought, retention's down a lot in this game. And this was early doors when I was just having to play around, understanding what was what from the tools that were available at the time. Our tool set's improved over the last 4 months considerably. And I think that was partly with me coming on board and partly with some senior product guys coming on board. We've really strengthened that function up. So that was just flagging up for retention, had a real impact, and just said something changed at this point. What changed? And obviously this was before I was at the company, so I didn't know what had changed, but people were able to piece together what had happened and remedy something that had happened. Another one was looking back over historic data and just saying something was really working in this game at this point. It's not impacting retention, but ARPDAU was significantly higher. What was the cause for this? And it turned out we had some functionality that was in there by error that then got corrected. But the functionality that was in there by error actually was giving some very, very high ARPDAUs. So we reverted to the functionality that was in by error. We actually kind of put it back in there and saw an uplift in that particular app as well. The other ones, just as an overall, just through more targeted UA, our ROI, install day ROI, has gradually been creeping up, which has been nice to see. So that was pretty pleasing to see that as well.
There is a certain time for a company when it needs to think about having a finance function. It's reached a certain level of growth or maturity, or something has happened. I mean, what would you suggest or what would you advise is that moment? When does a company need to say, we're ready, we can have a finance function, we can have someone like Adam?
I think once in companies like the gaming apps, because obviously they're needing some kind of funding to get that initial user acquisition, and it's not always going to work perfectly at first where you really try and ramp up. I think having someone there that's going to be overseeing the numbers, I think once you've got that first tranche of money come in, you've had your minimum viable product, you've taken it out, people are keen on it, and they're prepared to throw some money at you, you really need someone monitoring at that point, because otherwise you will burn through money. I think if you've got someone keeping tabs on the money at that point, and I think that will give investors some degree of comfort as well, that you've got someone really checking in on it.
We talked about the time to have a finance function, and you said, otherwise you're burning money. Well, there's also a point that if you're not exploring other funding options, you're burning money.
Yes, that's very fair. I think once you've demonstrated you've got something that potentially works, before that, you're not going to have a hope of getting any money. You need a good concept. Try something very basic with a little bit of seed money. Once you know that something's working, or you can get something to roughly work, it seems to be giving a few of the right signals. That's the time you can go out and say, look, I want some funds. We've got this. This is some early stage results. We've seen these positive things. We think we can do something with this. We think we can obviously improve on this as well, what we're doing at the moment. That's your kind of time to be going out. It's a very standard practice across all businesses where you're going out for funding. Get something that is roughly going to work, and then go and get some people to back it. These people know that not every one of these businesses is going to work. You've got people with different risk appetites. People that are investing at this stage know that probably 1 in 10, 1 in 20 is going to work. But they know that 1 in 10 or 1 in 20 is going to return 40, 50, 100 times at that point what their investment is. So it's just playing that game.
I'm always interested to hear how people in your position describe the options, describe the pros and cons. There's Pollen as velocity capital, there's going to your bank. There are a lot of companies not so long ago just put everything on the credit card if they're very, very early stage startup. I'd just like to have, from your perspective, just to go through and sort of do a SWOT analysis of the options so that I can hear it from your expertise.
Yeah, I think I'd start at the top and say just narrowing it down. While there's different vehicles, there's essentially debt and equity. Getting that gearing ratio right for the business is the important thing. It's a fine balance between giving too much of the equity away, which is what the founders of any business want to keep, because they know that's ultimately going to be the thing that's going to make them hopefully rich. So it is a fine balance. Obviously, getting some heavy backing in, you're not going to have the interest cover to be worrying about, thinking, well, I've got to be paying interest on that. It's not going to be eating away at the bottom line. But similarly, you want a little bit of eating away at the bottom line as well, because that's the thing that people are only really valuing companies on EBITDA anyway. It's real swings and roundabouts, and it's very different for very different businesses. I have got a bit of a grasp on gaming. I would say that's different to some of the tech businesses I've worked in the past as to how you would gear them. And some tech businesses run in very, very different ways. Some of them want to have a year's supply of cash in the bank and have no debt because they're turning over profits very quickly, whereas other ones in the SaaS models, it's just purely going to be funded by external investment. I think it's what you can get. I think if you can realistically get debt borrowing, I think you should absolutely take it, in my opinion, so long as you can continue to meet any interest payments. You model out your financial model and you think, well, if there's a downturn, you do your sensitivity analysis on it, and you think, can I keep on meeting these payments and these interest charges on things like a Pollen? And if you can, you should pretty much leverage as much as you possibly can on that, because ultimately you're giving away less of the business. And when an investor does come in, they can see the worth of it, and they are measuring it on EBITDA level. So we kind of push for as much debt as we can possibly get. I think it's harder where you are in that startup phase and you're burning more money than you've got coming in. Getting debt at that point is a lot more difficult. So I think early stage, you really do have to get that push. I think you've got to go for the investors. When you're starting to see a bit of performance coming through and you're starting to see results going in the right direction and you're starting to see a positive margin coming through, getting debt at that point's a lot easier, because they can see that the kind of trajectory a company's on, even when you're on a slight negative. If they can see that negative moving positive, that's the time you can start targeting debt more, because you're on the right trajectory.
I've done a lot of games research and reports and looking at the numbers, and it's a very robust, very healthy market. How do you see that playing out just a few months or so down the road? Because it may be that that's even a greater reason to explore options and to look in, as you said, financing options such as Pollen, or just basically trying to have a better alignment with your investors on your financing options.
I think down the road, as we continue on the track to the successful business that we want to be, I think we've got other options as well we can bring in. We can leverage more from our suppliers' credit lines, because obviously they leverage quite heavily the other way at first. They're paying you on 60 days, or you might be looking at 30, whereas you're having to be forced to pay them on 30 days. Mm-hmm. So you can kind of start bringing a little bit more parity around that. You're bringing significant business to the table for them. They realize that you could up sticks and move your business elsewhere to another network in some situations, or reduce spend with them. So I think they're aware of that. You get a lot more bargaining power as your size grows. So that's one thing that we can do in the future. Also, in terms of the Pollen and rates of interest you might be paying, as you're bringing more size and you're generating more revenue for them, again, you can look to be on more favorable terms, which I think is absolutely a thing. Also, from the customer side of things, you can look to be getting paid faster and just saying, look, we can put more and more business your way. You can go to customers with the model and say, look, if you do this, we can basically generate more and more revenue. This is where we are. This is where we think we can get to. You can get them on board that way. I think investments at that point, if we're further down the line, I don't think we'd take any more on if things go the way we'd want it to in terms of equity investment. So we're kind of weighing up what is ultimately going to give us the best return. Looking at those opportunities, we're going to take an opportunity wherever it comes in utilizing any kind of free borrowing, if you will, first, because that is a real opportunity. Sometimes, getting paid faster by people, as I'm mentioning, and also being able to pay people later is essentially free working capital, and it costs nothing. So that's your first one. That's your absolute best source of funding new business as your first port of call. And then just understanding that as you know what your margins are. If your margins are sufficient to cover the interest, then you go for the debt option. And then if your margins aren't at the moment, you go for the equity option, because otherwise you're going to be sabotaging your business if you can't cover your costs from a cash flow perspective. It's all just based around cash flow and modeling and scenarios, and you can plug in the different options And you think, well, if we go down this route, how does this look for us, and how does this look longer term? And sometimes I think if you go with that, like you say, you can ruin opportunity cost because you've got more money going out, so it can limit you hitting the accelerator. So you've also got to kind of think, if something's really working, we want to throw a lot of spend at it, can we model that out as well? So we're looking at all eventualities when we're financial modeling, and dropping in different funding and understanding where that kind of sweet point is that gives us some room to really hit that accelerator pedal if there's an opportunity there that merits it. Or also saying, what's the chance of that happening as well? We think there's a chance of at least one accelerator pedal moment happening within a given time. We know what our product roadmap is. We know what apps are coming out. We have an understanding of where we think they might go. Modeling is very, very, very important in assessing which funding option to go down the route of.
I want to pull out again to go a bit more macro than micro and talk about your learnings in the business. Maybe there's something that you already have, the biggest lesson that you've learned, or even some advice you wish someone had given you sooner.
You learn a hell of a lot probably in your first 3 months, but there is still learnings happening all the time. And I imagine that will continue for a considerable time into the future, because it's always surprising what someone will do. I suppose I would say expect the unexpected. If you have done mobile gaming, you could move into SaaS very, very easily. The other way around is harder. There is a lot more to learn in the app business. There's a lot more levers going on there. And I think, and the performance of those levers as well, is the metrics are the performance metrics are slightly different, even though some of the levers are they're kind of the same. Really, really read up on your metrics beforehand. I think retention is extremely, extremely important. If your retention figures start dropping, you are basically killing LTV, because you could acquire someone at a good price, and that's an easy thing to set. Is here's your CPI targets, and those CPI targets are only good if you're ultimately, and you've got an ARPDAU target and that's working. But your ARPDAU target is basically, to get to LTV, is completely influenced by retention. And if your retention takes a dip on day one, that retention ripples all the way through, and that just kills any cohort that's got that low day one retention. It's catastrophic for a cohort day. So I'd say retention for me probably is huge. And then your return, I've harked on quite a lot about your returns, but the returns need to be kind of your secondary target, because if you're not returning positively, you don't have a business.
There's also the question I wanted to leave with is, for everyone, no matter where they are in the company, no matter what kind of company for that matter, is always a point around how do you make the most out of your time? Time is money. Best productivity tools and hacks. I'd love to hear some of yours.
File your emails away when you've dealt with them. That's always a good one. Where you've got sent items, keep them in sent items if you're wanting something actionable from it, so you can follow up on it. Because I think sometimes things get missed and you're actually relying on that information, and then you kind of go, oh yeah, I meant to do that. Have a system in place to know what you're doing when you're meant to be doing it. If you're doing something all the time, find a way to automate it. I come into businesses, and all I've done is basically, in all the businesses I've worked in, as I've come in, I've seen the systems and the kind of early stage, and you build systems up and you realize that, okay, it doesn't need to just work now. Don't think of a system working now, but think of the system working at where the company wants to be. And sometimes you will have to change systems. You cannot go to that absolute gold standard, because it's just not practical at the time for cost or whatever reason. But think, well, I want a system now that will fit within the budget, that will get me to X point in time. And I need that to talk to other systems, and I don't want to be doing the same thing time and time again. So I mean, for me, systems is pretty much what I'm doing all day. And so if I'm pulling the same reports on a daily basis, I want those automated. And obviously I was pulling the reports at the start. Now they're more automated, so it happens automatically, or finding a quicker way to do something. But I think for me, I kind of have a more of a set day than I've had in most of the finance roles. But I also think you need to keep some time spare. I think if you fill your day up, you have no time to be reactive or proactive. Two very different things. Things can happen that you don't foresee. And I think that's where you need to have that chance to be reactive to stuff. And if you've not got spare time, in your day to deal with anything like that, because you will get asked for certain things that you weren't expecting. You need to have that spare time to do that. And also similarly, to grow, you need to have that proactivity. You need to be thinking, well, what else can I do? Leave some spare time in your day. Don't fill it up. But you need some spare capacity. It's something that I learned a few jobs ago, that, you know, if you're overloaded, if you're overloading people and then you add more to them, you're going to lose those people. Whereas if you're underloading them as well, you're going to lose those people, because, yeah, they've got a chance of being proactive, but not everyone's going to do that. So they're going to find themselves bored. But if you leave the right amount of spare time, sometimes you're going to overload them, but not all the time. It's just leaving that right spare time, and it will average itself out. And sometimes, you know, you'll find that's the work-life balance. One of the most important things I would say to people in business is to do that. Give yourself some free time. You'll need it.
But that's very valuable and very true, because, as you said, something might need to be addressed quickly, or there might be an opportunity to think a little bit, as you do. You know, you said you came in, you looked and you saw some patterns, you were seeing some things. You don't see these things if you're completely overloaded. Adam, it's been wonderful talking with you. I can't thank you enough for sharing all of this, your experience, insights, some great anecdotes, even some fun moments. In case the audience here wants to stay in touch with you, wants to connect with you, maybe has some questions, maybe someone who's new to finance in an early stage company wants some tips, some advice, how would they do it?
People can drop me a line through LinkedIn. Don't just send me a request with nothing around it, because that's probably not going to pique my attention. If I've got some junior finance person, I'm going to think, tell me something about yourself. I'm not going to start looking at you. If you're connecting with me, if I connect with anyone, I will let them know this is why I'm connecting. I think it would be useful, unless obviously you've met someone in the course of business. You already know about one another at that point. Just send a quick invite. That's fine. You're going to get accepted. I've met you or spoken with you. That's perfectly acceptable. But if I don't know you, or I don't know someone and I think they're useful to connect, you know, do that. And that's one of the things you can sometimes do with that free time. A few connections sometimes, or looking into things that you might not have thought of, is great. I had someone today drop me a line on LinkedIn, put something useful in there. I thought, you know what, that's interesting. I accept, and just dropped a quick line back. Thanks for the introduction. So bring something to any introduction, and yeah, I will probably give you the time of day. Don't put anything in there. You probably won't get the time of day from me.
And that's a wrap for this episode of Mobile Gaming CFO Insights. Be sure to check out Pollen.vc for updates on upcoming episodes and discover options on how to finance your user acquisition and scale your business in a capital efficient way.
Goodbye.